there's even more evidence that oil is setting up for another enormous bust. Even though oil is already in a bear market, there is some very counterintuitive things that have just been announced and are happening in just the last couple days in spite of the oil bear market. So the oil prices, when we're doing this live stream show on Tuesday, September 3rd, 2019, the WTI crude price is at $53.98. Brent crude's at $58.26. And those are prices, if you go back and listen to my latest Art Berman interview from the last couple weeks, I think it was 2 weeks ago, and he goes through all the financial disclosures, all the documents, and the SEC filings of the shale oil producers, and they need about $60 a barrel on WTI to break even. So they're losing money. And the stories I'm talking about, with oil is already in a bear market, the oil price is down enormously just in the last 6 to 8 months. It's down a lot. And even despite that, you have factors like the Saudi Aramco. It seems that they just made some type of administrative change with their sovereign wealth fund, and also whoever is running Saudi Aramco. The chairman of Saudi Aramco is just replaced, and they're fast tracking the initial public offering for Saudi Aramco. So this is very interesting. Normally you would think that they would want to sell at the top when the oil price was rising, that they would get the best price for their assets, but this is not the case. And this may have to do with the fact that the oil market, they're sensing that the global economy, the global macro data is bad. They're sensing that the oil price, the demand for it is weakening, that the oil price might not rally for a while, because it would make more sense for the Saudis to wait. And here you have, that's one piece of data, that with the fast tracking of the Saudi Aramco IPO again, because it doesn't make sense to want to sell it when oil prices are cheap unless the Saudis are desperate and really need the money, really need the dollars. They have other social programs, other investments they want to make. They have to use social programs to keep the people from rioting or uprising and maintain the status quo there with their government. And that's what a lot of OPEC countries do. And this brings me to my next point. So you would think that rationally, when OPEC wants higher oil prices, that rationally OPEC would want to cut oil production. So you would think that rationally OPEC would say, hey, oil prices are too low. We're not making that much money, even if we're pretty low cost producers at $30 or $40 a barrel. And let's cut production. Let's move the price back up. Let's make more money for each barrel of oil we produce. Let's get better margins, etc. And that is not what's happening, actually. We just got data from August, and OPEC increased production for OPEC rose for the first time in 2019. In August, OPEC production rose by 200,000 barrels per day in August, the first collective increase since the OPEC production cuts took effect at the start of the year, and the production increases came from Saudi Arabia, Nigeria, and Iraq. And I would say that the reason the production increases happened, and this is counterintuitive for most people, because most people would think, oh, they want a higher oil price, they're going to cut production with a low oil price now. But normally, if you follow OPEC, they tend to not do this. What normally happens, and I was an energy analyst, and I learned from one of the best, Robert Rapier, who's been doing this for almost 30 years. Normally, what OPEC does is they tend to, a lot of these OPEC countries, the majority of revenue that comes in and runs the government and runs social programs, the majority of that revenue for OPEC countries is oil. So when the oil price drops and is in a bear market, counterintuitively, what these oil producing countries in OPEC actually do is they actually either, one, if there's production quotas, the amount of production quotas, the OPEC countries, not all of them, but some of them, sometimes all of them, but normally some of them, they try to cheat. So they'll produce a lot more than they're claiming that they're producing, and then they'll sell the oil on the black market, or they'll sell. There's been stories for years of BP and others buying black market oil from Iran. There was stories about this, 10 years ago. I remember speaking to oil traders about this from a decade ago. But what is happening, though, is these OPEC producers, they actually increase production because they need the dollars. So they don't care that they're hurting that the oil price was already in a bear market, that increasing supply to the oil market with reduced demand and already too much supply is potentially going to lower the oil price, especially with the global macro data and the increase in tariffs on American oil that China has put on. So these OPEC countries don't care about that. They are so desperate just to get more revenue coming in because they need it to fund their government budgets, they need it to fund social programs, etc., that they are willing to basically hurt themselves by producing more oil. They hurt their margins of producing oil, and they are making more dollars total, but they're making it on volume. So it's a really stupid long-term business strategy. So if OPEC continues this, and by the way, I have an article up here from OPEC abandons, quote, whatever it takes strategy and boost production. OPEC is now producing above their quota at 136%, I think I saw. Yeah, let me confirm. Yeah, 136% above quota. So they're producing way too much. If they were operating more prudently as not a national oil company, as a private sector oil company. Now, a private sector oil company, if they had too much debt on the balance sheet, they might not be able to cut oil production or cut natural gas production and try to wait for higher prices. So this is the problem with a national oil company when they have all these social program commitments and so much of the government budget every year is reliant on oil revenues. And then also with private sector oil companies like shale companies that have drastically leveraged their balance sheet with debt. Also, if you have hedges in place, you have to produce the oil. But if you have a hedge in place, so if you're selling the oil at $60 or $70 a barrel into your hedge, you're at least making a profit on that. But those hedges could roll off in 2 or 3 years. So the oil industry, guys, there's a lot of counterintuitive things that have come out just in the last couple of days. You have the OPEC production increases now. They're producing at 136% above the production cut quota. And these countries are producing more oil. And then you have the acceleration, the fast track, as it's called here, on oil. One of the best free research websites for the oil market is oilprice.com. You can bookmark it. It's free. There's a lot of good articles and research on there and the different crude prices. It's a good free resource. And their breaking news headline is that these investment banks are talking about the fast track of the Saudi Aramco IPO. So it's a little curious how the Saudis want to do this. They must have some financial problems for sure, especially with the data that we saw with the Ghawar oil field, how it's not producing anywhere near the amounts that we thought, and they had to bring on more marginal oil production, over 1 million barrels per day, I think, at more marginal wells, which are, I think, higher cost. So it's curious that the Saudis want to fast-track the IPO now and not wait for an oil price rebound. But let me just talk about, this is not going to be a really long show. I just wanted to get this out there and updating. You know, guys, still, Zero Hedge has still not done a story in the last 24 hours on the stopping of payments on the dollar bonds for the Bank of Jinzhou. I may have to do another video later on this or tomorrow. I'm shocked that Zero Hedge has not done anything on this. And I'll tell you why. I just found another article last night before bed, a Reuters article from last week talking about how the larger Chinese state-owned enterprise banks are already starting to have their earnings hit, and they're already the larger Chinese banks are already starting to get pissed off that they're going to have to spend more resources on bailouts for a lot of other smaller regional Chinese banks. So there's another article here called A Murderer's Row, Oil and Gas Bankruptcies to Accelerate as $137 billion in oil debt matures over the next 2 years. Oil and gas companies are facing an onslaught of bankruptcies as the, quote, shale revolution appears to be coming to an unceremonious end, at least on Wall Street, according to this Wall Street Journal article cited in the Zero Hedge article. Companies like Sanchez Energy, Halcon Resources Corp., and 26 other oil and gas producers have all filed for bankruptcy this year, already matching the 28 industry bankruptcies from all of 2018. So it's not a massive number yet, but the trend is starting to grow. The number is expected to rise as debt maturities for those looking to cash in on the shale revolution and make bets on higher oil prices years ago are now looming. 5.7% of all energy companies with junk-rated bonds are defaulting as of August, the highest level since 2017. The metric is, quote, considered a key indicator of the industry's financial stress. So the defaults are on the rise as companies struggle to service debt, bring in new money, and refinance existing debt. The once darling shale business model has been under significant scrutiny from Wall Street over the last 18 months, adding along with class action lawsuits, and the pension funds may be tired of getting fleeced, adding to the headwinds for many companies. Investor interest has faded after years of meager returns, while at the same time companies struggle to meet their cost of capital with oil prices below $60 per barrel. Private companies and smaller drillers have felt the most pain thus far. These companies, quote, collectively generate a large portion of U.S. oil, and their distress is indicative of wider distress throughout U.S. shale. Patrick Hughes, a partner at Haynes & Boone, said, quote, they were able to hang in there for a while, but now their debt levels are just too high, and they're going to have to take their medicine. There's an interesting chart here about bankruptcy filings and default rates in the energy sector rising again despite oil prices being above 2016 levels when the last such surge occurred. So there was a big oil bankruptcy bust in 2015 and in 2016. Late 2015 and in part of 2016. There was almost 35 bankruptcies. There was in just a certain part of the year. So there was, I think, 40 in 1 year. Halcon filed for bankruptcy in August, just 3 years after it had last filed for bankruptcy. Wow, so that's the second time this Halcon Resources has filed for bankruptcy twice in 3 years due to a production slowdown in West Texas and higher than expected processing costs. The company's chief restructuring officer, wow, they actually have a job title, chief restructuring officer. I guess maybe they expected bankruptcy again, which we guess is probably becoming somewhat of a permanent position after filing bankruptcy twice in 3 years. Said the bankruptcy was partly a result of lenders cutting the company's credit line by $50 million earlier this year after it violated its debt covenants due to too much leverage. Remember, I've warned you about mining companies with debt covenants, and people have told me it's no big deal, it doesn't matter, debt covenants do matter. Then you're at the whims of the bankers. Once you breached the debt covenant, the bankers can force you to sell good assets. They can force you to do a lot of things, or they could call on the loans if they want. It really depends on the whims of the bankers. Sanchez Energy also filed for bankruptcy in August, citing falling energy prices and a dispute with Blackstone over assets that were jointly acquired from Anadarko Petroleum in 2017. Blackstone says Sanchez defaulted on a joint venture deal to develop the assets, and as a result, Blackstone was entitled to take them over. Other shale drillers like EP Energy Corp have also missed debt payments. And the Bank of Jinzhou missed a debt payment too, a dollar payment, which Zero Hedge doesn't seem to care about. EP missed a $40 million interest payment due August 15th as it continued to struggle from the debt piled atop of it as a result of an Apollo-led buyout in 2012. As of Q2 2019, the company had debt to the tune of 6 times its EBITDA. And remember, earnings before interest, taxes, depreciation, and amortization, which is EBITDA, is not really earnings. It's not earnings. So it is a very laxed debt ratio. Very, very laxed to have debt to EBITDA. Okay, debt to cash flow, debt to free cash flow, a lot more strict, especially debt to free cash flow. The company, if you were doing debt to free cash flow, the shale producers would have been bankrupt a long time ago. There are very few of them would be alive still. The company has said it has to mid-September to make the payment and is considering a range of options, including bankruptcy, to deal with the issue. Lately, the slew of bankruptcies isn't so much a result of low crude prices either. In 20s, and I remember, I've been saying this now in my oil updates, that a lot of this doesn't necessarily have to do with low crude oil prices. It has to do with CapEx to continue to re-drill these oil wells. The CapEx is not coming down anymore. And then also the ability of the shale producers to raise more junk bonds and to sell more shares. And that has evaporated. In 2016, because these shale company CEOs promised earnings for some of them for 10 or 11 years, and they have not delivered on any of them. No earnings, no free cash flow, no dividends, no nothing. In 2016, when crude prices were below $30 per barrel, 70 U.S., so it was 70, not 40, I stand corrected, 70 U.S. and Canadian oil and gas companies filed for bankruptcy. Crude prices have nearly doubled since then. Instead, it's more a result of debt, and the many companies who took on debt after the 2016 slump all face upcoming maturities over the next 4 years. The mining industry also took on a lot of debt. Now that the gold and silver miners have higher gold and silver prices, I would expect, guys, a lot of capital raises. Be on the lookout for press releases of companies raising $100 million or more in the next couple months. Certainly less than 6 months, especially if metals prices stay at these levels or go higher. While just $9 billion is set to mature throughout the remainder of 2019, about $137 billion will be due between 2020 and 2022, according to S&P. And debt of companies like Alta Mesa Resources remains as risky as it gets. After being handed a $1 billion blank check to invest in shale, the tide has turned on the company in a big way. Paul Harvey, credit analyst at S&P, said, quote, "A lot of companies are highly levered and facing maturities on their debt that I like to call a murderer's row. Maturities are coming year after year." And that means there would have to be higher oil prices for some of these oil companies to refinance their debt. That would not mean that they could pay off their debt, but they would have to refinance their debt, maybe change the interest rates and extend the maturities of the debt, or maybe pay off a little bit of debt with some free cash flow. But it does not look in the short term, guys, like we are going to have higher oil prices. It looks in the short term like we're probably going to have a bust. And I'll talk about the stock charts of some of these oil industry ETFs and some companies in a second after this article. According to S&P, the lowest possible yield an investor can earn on a bond without the issuer defaulting stands at 7% as of July in oil and gas. That metric is about 4% for the overall market. For junk bonds, such yields are almost 13%. Energy companies have predictably backed away from the high-yield market as the cost of capital has increased, with high-yield issuances falling 40% from the same period a year earlier. Wow, big decrease. Overall, high-yield issuances were up 32%. Wait a second here. Got to reread that. Energy companies have predictably backed away from the high-yield market as the cost of capital has increased, with high-yield issuances falling 40% from the same period a year earlier. Okay, so overall high-yield issuances are still up, but I believe oil industry high issuances are down. I'm not sure if that sentence was grammatically correct, and that's why it was confusing. Tim Polvato, the head of U.S. Energy for the Paris-based bank Natixis SA, concluded any available capital structure is going to be more expensive than it was a year ago. As in the case of many bankruptcies, equity holders could be all but wiped in many of these shale companies, while bondholders jockey for seniority and priority as the likely new owners. And the bondholders probably would not want the equity, so they may dump it. So let's talk about some of these before I look at listener questions and comments and super chat. Hopefully I have super chat. But thank you very much to my almost 150 Patreon account contributors. Really appreciate it. You guys are really taking a lot of stress off my life. And my almost a dozen PayPal monthly contributors who have signed up on my website. Thank you very much. So the Van Eck Oil Sectors ETF, OIH, Oscar, Israel, Harry, that one is down quite a lot. Since April 22nd of 2019, it was at $18.50 a share, and it covers a basket of these oil service companies like Halliburton and Schlumberger and some of the others. That one is down from $18.50 in April, at the end of April, down to $11.34 now. It's down a lot. Let me look at another oil industry ETF. The Energy Select Sector Spider Fund, or XLE, Xavier Lizzie Elizabeth. That one is actually not down too much. That one is not totally collapsed yet. It was at 68 in April, and it's down to 57.2 now. So that one has like ExxonMobil in it, Chevron, ConocoPhillips. That one, EOG, that one's not down nearly as much. The big damage, guys, from what it looks like, the big damage, let me pull up a chart here, Schlumberger. So Schlumberger, which is one of the more respected oil service companies along with Halliburton, Schlumberger is Sam, Lizzie, Brian. Those shares since April 1st, 2015 are down from $94.61 down to $31.72. Let me look at a more recent chart. A more recent chart, it was on October 1st, 2018, it was at $63. So this stock is more than cut in half, basically. People don't like me saying basically. That stock is down basically half since October 1st, 2018. Down from $63 per share down to $31.73. And these oil service companies are having to discount to get any business, heavily discount. And Schlumberger, if you think Schlumberger is going to rally, they have a 6.33% dividend yield, but that could be a yield trap. That could be a yield trap there, a value trap or a yield trap. That dividend may need to be cut. Because normally with companies like that are that large, having a dividend that high is risky. The market seems to be pricing in maybe that dividend may be cut. And I don't think, based on what I just told you, how OPEC now is increasing production when the oil price is already in a bear market and the shares are looking bad, and in some of the other things I talked about, not looking like the oil bear market is going to end anytime soon. Especially if the global economy, especially something collapses. Like if emerging markets collapse or the European Union collapses, although the European Union is transitioning faster to electric vehicles than other countries, or China collapses, or things get worse here in the US. Halliburton shares, let me just talk about Halliburton shares. Halliburton shares are down an enormous amount, even more than Schlumberger. So since October 1st of 2018, Halliburton, which is Hal, so Harry, Alice, Lizzie, is down from $42 per share down to $18.76 per share, with almost a 4% dividend yield at 3.82. So Halliburton has gone whacked. And remember, about a month ago, another oil service provider, Weatherford, they went bankrupt. So very interesting. Hey, thank you, Greg, for the 2 super chats. I appreciate it. I have not looked at Black Swan. I have not looked at Alexco today, but it sounds like I'll be happy. A lot of my shares were purchased at around 30 cents per share a couple years ago, 2015. I just didn't even check my account and held on, thinking, silver would eventually rally. Okay, let me take a look at listener questions and comments. This isn't going to be a super long show because remember, I already gave you guys a lot of content a couple hours ago. I don't want to totally destroy my voice, but I also want to get to 5 million views as soon as possible. So I'm trying to balance that. Bubs says, seems like they want to crush the shale some more. I don't know if they want to crush the shale some more. I think it's because the Saudis really need the dollars. And that's why they want to sell a large stake in Aramco on the IPO, and that's why they're producing more oil. I think there's a problem there, maybe a hole in their government budget or other problems. There could be a real hole in the Saudi finances right now. Saudis were spending a lot of their wealth fund a couple years ago. They're blowing through it pretty quick. I remember a few years ago when there was another oil bust, and the Saudis were blowing through their sovereign wealth fund pretty quickly. Ryan asked an interesting question. How low do you think oil will go? $30 a barrel. If oil could go that low, if oil goes that low, there's going to be a lot of bankruptcies, Ryan. A lot. Now, China, it would be very smart for China to come back in and do what they did in 2008 and buy very long-term oil contracts above spot price. People were laughing at the Chinese when they did this in 2008. They bought long-term oil supply contracts from both Russia and Brazil. They paid for like decades of oil. I think it was $10 above the oil price back then. When oil hit 29 in 2008, the Chinese bought very large long-term supply contracts back then. I wouldn't be surprised if China tried to do that now. If they're saving their dollars up, that's something that would be a smart purchase for them. But if the oil, guys, if the oil price right now, we're, like I said, we're barely above 50. If the oil price goes to low 40s or high 30s, there's going to, basically every $5 the oil price drops, there's going to be more and more bankruptcies. And this is not just with the oil producers' inability to cut production. This is the oil producers cannot raise capital. The oil producers could not even generate free cash flow at higher oil prices. And the oil producers need back to that capex bomb again. This all has to do with the resource industry, and the shale producers have a ton of capex to spend for maintaining oil production at shale well, because after 2 or 3 years, after 2 years, the production at a shale well is down more than 75%, and after 3 years, it's down about 90%. The production of the oil well is down. So we're setting up, guys, the stuff that is setting up, it's setting up for a very, very big oil bust in the next couple years unless something changes. Some global macro factor, a lot of oil production comes offline. I'll tell you, OPEC, if OPEC didn't need, if those OPEC countries had diversified economies and their economies weren't so reliant on oil, they should be not producing that oil. They should be cutting the oil and saying, you know what, we're cutting supply. We need prices higher. That's not what's happening. By OPEC increasing production, they're desperate for those extra dollars. They're willing to drive the price lower to make the extra dollars from selling their lower priced oil on volume. It's not a smart, prudent move that should be done in a free market. But this is what governments do to survive, for social program promises, and also for their government budget, when so much of the government, for some of these OPEC countries, guys, I believe for Venezuela, I think 90% of their government budget was on oil. And for a lot of these OPEC countries, it's very similar. I don't know if it's 90%, but it's very high. Pipe Fitters asks, how do you give a super chat? If you're on your smartphone, there should be a tip button. There should be a $sign button on your smartphone. I'm not sure how else to do it. Otherwise, you could just sign up for my Patreon. YouTube actually takes more percentage than Patreon does. So Patreon would be more beneficial to me, but any of those are fine. Black Swan, good question. What about copper? If oil collapses, would copper crash and rebound coming out? I think copper has been tracking oil pretty well. The copper, I haven't looked at the copper price in the last couple days, but the copper price was down around, $2.50 a pound the last time I looked at it last week. I believe it was at $2, around $2.50 a pound, give or take. That's a price where the lowest cost copper miners can kind of eke out a profit, but the higher cost copper miners are in trouble. But remember what I've said, and basically no one else in the gold and silver industry is talking about this. When low copper prices and copper miners coming offline or going bankrupt and shutting down their copper mines, and less copper mines coming online, is good for silver prices. It's very good for silver prices. That means less silver byproduct available each year. Andy asks, I wonder if the tariffs have sunk coal exports to China. China has a lot of coal from Mongolia, though. So I don't know how much, I haven't looked at the data in a long time of how much coal China was importing from the U.S., but I know China has a ton of coal in Mongolia to import. And the ADV China guys have talked about how the coal barons that live in mainland China but own mines in Mongolia, that they have special connections to the Chinese government that get around all the environmental laws. The Chinese Communist Party should be buying pork. They should be buying U.S. pork or other pork. I don't know if they are. And anyway, the U.S. is the world's second largest pork producer. So if they're not buying from the U.S., they're not going to be able to buy nearly the volume that they need. The U.S. is by far the second. China was the number one world's largest pork producer, and the U.S. was by far the world's number 2 largest pork producer. And 1 and 2 were very far gap between the rest, if I remember correctly. No, I talked about nickel already last week. There's more nickel in a lithium ion battery than there is lithium. And nickel is a byproduct of base metals, and base metals are in a bear market. So there's a good chance that base metal mines will shut down even if nickel prices rise. There is no pure nickel mine. Well, the Russia Norilsk nickel has probably the closest to a pure nickel mine. That's a truly super high grade, super low cost, super long reserves. Tier 1, it's called a tier 1 super high grade nickel mine, but even then I think a lot of the revenues at the mine are still in copper. I think only about 35% or so of the revenues at that mine are still in nickel. Nickel's a byproduct. So nickel's kind of in the same situation as silver. So if the main base metal that's being produced with the nickel or with the silver, if that's in a bear market and those mines shut down, it benefits nickel, it benefits silver. That's my view. That's my take on things. Not financial advice, just my opinion. So if copper does have a bear market and copper crashes, and let's say China can't buy copper, or either China doesn't have the dollars to buy copper, or China decides we have enough copper, we don't want to buy any more copper, that would really collapse the demand side for the copper market. And that would benefit silver, in my opinion. Andy says some of these shysters are passing off ham as bacon. Are these the same people like some of these restaurants that were passing off green squash as avocados? Yes, and before you say that didn't happen, go and look up that in search. There were restaurants that actually tried to bullshit people. That actually tried to bullshit some people that green squash was avocado. When the avocado prices rose and Trump was contemplating the Mexican tariff on avocados. On imported avocados. Rick Rule has been bullish nickel for years. When I was up in Toronto, he was talking about how nickel is far... Rick Rule used to say that the lithium-ion battery should be called the nickel battery. I said they have low dollar reserves. They're either low dollar reserves are either out or they're rationing. One of the two. Because if China had the dollar reserves, why would ICBC Bank, which is one of the two largest banks in China, or the People's Bank of China, their central bank, why would they not save the Bank of Jinzhou? Bank of Jinzhou did not pay their dollar bonds. Okay, they're causing contagion risk. They're causing interbank credit to rise again. They're causing bankers to not trust each other anymore to lend to each other. The Chinese government tried to put that mistake out, tried to put those fears out in the last month or two. And to have those fears spike again would go against everything they've been trying to do. So my rationale is that they don't have the dollars. So they would like to have stopped Bank of Jinzhou from defaulting on their dollar bonds because they know that it's going to cause the other small regional Chinese banks now to have problems as well. Sprott just sent me an email. They're endorsing platinum now. They think platinum's a good buy. They think platinum's the value out of all the metals. I just got an email about that in the last day or two. Okay, somebody likes my cartoon, economic cartoon. Let me see where it was. Where is this? Saudis to maintain living standards. The Saudis need the cash flow for social programs to prevent civil unrest and also to fund their government budgets. The Saudis are running a war in Yemen too. So the Saudis are funding. The Saudis rely very heavily on oil to fund their government budget. A large percentage of their annual budget is from oil revenues. Excuse me. And then on top of that, the Saudis are also funding a war. Bill thinks silver and oil will both be in the 30s soon. If oil goes to the 30s, there will be bankruptcies. If silver goes to the 30s, that will be good for silver. Good for me, too. I kept my speculative silver position in Alexco. I am not the Elon Musk of financial podcasts. Let's just say I don't like Elon Musk. I'm working my butt off and doing it honestly. If you're going to give me a compliment, please don't compare me to Elon Musk. And then very shortly, the guy who says I'm a Tesla basher and know nothing, who's comparing Tesla to Apple. Except Apple was consistently profitable since the iPod came out. You cannot compare. It's not an honest comparison to compare Tesla Motors to Apple. Apple has been consistently profitable since the iPod came out. They've had winning product after winning product even without Steve Jobs. Tesla has had, what, one or two profitable quarters in the last decade? Something like that. There's Tesla employees leaving there's Tesla employees who used to work at Apple and then went to go work at Tesla, and now after a couple of years they've sacrificed their stock options and they're leaving Tesla, I think, to go back to Apple. Look, it's a big red flag with the accounting department and stuff at Tesla, how much the turnover in their accounting department, their turnover in their autonomous driving software department. Those employees and their chief technology officer, those guys are giving up so many millions of dollars in stock options to voluntarily sacrifice them at such a high stock price. There's red flags there. They're literally leaving millions and millions of dollars in stock options on the table by not staying for another few years. If you don't understand how things work at companies. No, I'm just Coises. I'm just saying that some people are comparing Tesla Motors to Apple now, and I'm saying that it's not a good comparison because Apple has been consistently profitable since the iPod. Apple has a long list of winning products. iTunes, they have a moat. There's the transition of people leaving the iPhone and getting rid of their music and their video, their music, their pictures, all those things. It's an expensive transition. If the global economy is going to have a lot of problems, I'm not bullish on uranium yet. I do like Cameco long term. I think Cameco will survive. Just my opinion, not financial advice. I think Cameco will survive. And yeah, Apple has lawsuits, but Apple's still making money so they can pay off the lawsuits. I'm not saying Apple's perfect. Apple manufactured in China. I don't necessarily like that either. I don't think it was, for Apple's profit margins, it was smart to manufacture in China. But then once Apple manufactured in China, all their IP and tech got stolen. Do you think that was smart? I've talked about the pumpers in Vancouver, guys. Now that gold and silver are high, that's going to be on the menu. That's going to be next. All the junior gold pumpers are going to be right back out. They're going to be paying big bucks for YouTube videos and other stuff. For advertisements on YouTube videos and other stuff. Caveat emptor. Buyer beware. Please hit the like button if you haven't done so. Thank you guys very much. I'm gonna take a break now.